Really pleased to be hosting this panel for you. My name's Akhil Shah. I head up the climate tech sector for UK corporate banking at HSBC, which in practical terms means I mostly focus on kind of later stage commercialized technologies, funding the scale up of them into profitability and beyond, complemented by our innovation banking division, which focuses right from early stage through to kind of Series A, B, C and onwards. So within HSBC, we've got whole of market coverage in climate tech. And one of the biggest themes that we see is collaboration with private capital. So it is great to have four people here who are active in that ecosystem, representing very different types of capital, private capital providers, to dig into a conversation of how we all work together to scale up innovation. So I'll let the panelists introduce themselves 30 seconds, and then we can really dig into what exactly they're working on.
Thank you, Akhil. Hi, everyone. My name's Cam Ross. I'm the CEO of Green Angel Ventures. And of this panel here, we'll easily be the earliest stage investor. So we're a specialist UK VC, and we invest into companies really super early, like seed and pre-seed stage. Typically, this is two people and an idea, or a very small number of employees. They may not have revenue yet. They may not have clients. But what they do have is a specific technology or a process that has the potential for a real climate impact over sort of 5 to 10 year period. And we really want to be part of that journey throughout that period to give a great return for our investors and also to make very sizable climate impact over that period. Thank you.
Hi, everyone. I'm Duncan Hale. I'm from Schroders Greencoat. I think they put me next to Cam as a bit of a joke because we do almost the exact opposite end of the spectrum. We invest into large infrastructure projects where we can identify cash flows. So looking at things like renewable energy, solar, wind, as well as things like batteries, green hydrogen, large heat pumps. My role is to take all of those projects that the smart people at Schroders Greencoat find and then put them together in a portfolio to meet investors' requirements.
Oh, fantastic. I should be actually sitting between the two of you. I would say we represent the missing middle. Well, we can speak about that a bit later. Responsibility, I'm Stephanie Bilo, working on investors and on also products. Responsibility is the emerging market specialist of M&G, and we focus on investing for impact as well as financial return in emerging markets. We are operating in more than 70 countries across the globe. That's really 70 countries from some of them that you probably haven't heard too much of. Africa, in Latin America, and particularly when it comes to climate investments in Asia. We do mostly private credit, also private equity, and we'll speak, we've been investing in climate, for climate, be that climate mitigation or climate adaptation for the last 15 years. And we really are one of the specialists in this field with regards to also measuring what we actually achieve by our financing solutions.
And hi, my name is Simon. I'm the co-founder and CEO of a company called Climate. Climate is a startup, which is maybe slightly too big to take money from Cam. What our role is to help scale the technologies that can take carbon out of the atmosphere and put it somewhere. So we take the capital that different kinds of capital providers have, whether through offtake agreements, debt and equity instruments of various kinds, and put that capital to work by helping large corporates to meet their net zero targets by investing in these kind of green tech technologies. So that could be an offtake agreement for, say, a biochar facility able to get off the ground via debt or equity provided from an institutional investor or other instruments. We're roughly 20 people, so it's an emerging market, you can say, the CDR space, but very, very instrumental in getting us to net zero.
Brilliant, thank you. Cam, let's start with you. Earliest stage of the investors. What are you looking for, really, when you get into these businesses? What do you look for?
Yeah, so it's pretty simple. There's really only two things, maybe two and a half. The two absolute prerequisites for an investment for us are that the startup business needs to show a really terrific potential for very sizable climate impact over the lifetime of that business. Today, that's going to be zero. This is very early startup days, but maybe their technology can be scaled, maybe it can be licensed, maybe it can be adapted to have substantial scale over that long term, like I was saying, sort of 5 to 10 year period. And the second criteria sits alongside that, and that is a potential for very sizable financial return for the investors who are putting money in at this early stage. We are absolute great believers that these two things of financial return and climate impact go completely hand in hand. You cannot have the scale of climate impact that you want if your business is not profitable and if it is not returning decent money to its investors, because it is not growing and is not giving that the financial upside to be reinvested to allow for an exit to a company that will then scale that business and its technology even further. So those are the sort of two primary ones. The sort of 2.5 one, I would say, is that part of our funding comes from a very large angel investment network called Green Angel Syndicate, which has got more than 300 people in it. And the vast bulk of those people work in or have worked in the sectors in which we invest. And so we really like to be able to use those people and their background and their expertise to help operationally to grow those businesses. We put people on the boards. If there's challenges of growing those businesses, we quite often put people in to help those companies to grow as well. So that's a kind of 2.5. The real key thing is that message of the intertwined nature between climate impact and financial profitability and growth for those businesses.
Brilliant. And Duncan, for you at the other end, what resonates with you there and what's different?
I mean, I think that the kind of the thing that really is consistent, and I think we'll probably all kind of talk about how consistent it is kind of, we don't think that there is a compromise in terms of investing into something that does provide good, while at the same time being able to provide significant kind of financial benefits. When we think about kind of who we're investing on behalf of, who are the people that who kind of trust us with their money, it's generally pension funds. It could be it could be people investing into balanced funds. It could be kind of just individuals, kind of wealth investors in the stock market. The things that they're looking for from us are they want a return. And so kind of being able to deliver a return that is in the region of kind of 8 to 12, 13% is consistent with what we're telling them they're going to do. But importantly, what's really important from our perspective as investors into energy transition infrastructure is that we're providing a very, very different type of risk profile that they see elsewhere in their portfolio. So the risks that we take generally within our portfolio are things like inflation, power price, weather risk, all the things that you don't find elsewhere in other people's portfolio. So it's very, very attractive from that perspective. And then last but not least, and this is particularly true for when we're looking at people like DC pension investors, kind of the ability to do something that is tangible with their money is really important, and kind of the tangible benefit, kind of demonstrable benefit that you can do in terms of investing into the types of projects that we do is really helpful for them. In a market where it's really important to be able to engage with your end investors, kind of the ability for us to be able to show the types of things that we're investing to our investors is super important.
Brilliant, thank you. And Stephanie, how does it look in emerging markets? And are you normally investing on your own, or is it alongside partners?
Yeah, so maybe first a step back. I think when we think about climate innovation, often people think about technology, early stage things, and so on. And I just wanted to add to that most importantly, there are many solutions in climate already, and we need to make them scalable now. And what comes to that in addition is climate solutions cannot be only invested in UK and developed markets, but actually need to be also invested in emerging markets. And the thing is twofold. Every dollar you invest in emerging markets, you can achieve many more CO2 emission savings than in the developed markets. So that's one interesting point. But much more important is also that there is an enormous energy demand growing in these countries. And, also with regard to generally the economic growth that is developing from there, emerging markets simply need to be part of the solution. And there's an enormous infrastructure gap still out there. And that's why we are focused on that. Now, where are scalable solutions, and who is investing with us in that? scalable solution, first of all, again, needs exactly the same conditions as you just mentioned, be that early stage or late stage infrastructure. They need to make it an attractive risk-adjusted return, and that's very much true for us as well in emerging markets. And we calculate what's the impact on that in terms of climate. But who's investing with us? That's pension funds as well. When we offer solutions that are de-risk and take away some of the emerging market risk in the first place. We have structures where UK government or the German government support us with this. And so it's palatable in terms of risk return for pension funds. But we also have a lot of wealth clients. And of course, the public sector itself is a big investor.
Right. And then if I come on to corporate offtakes, because we've talked about direct investment, we've talked about debt and equity, but actually, when you're looking at carbon removals, how can corporate demand become a source of capital?
I mean, first of all, it's important to say that this is very much what already is happening in similar spaces like the energy sector. When you sign what's called a power purchase agreement, you are effectively given a guarantee that if someone builds a wind power facility, you will buy the power that comes out of it. And then against that guarantee, a bank or another investor is able to provide an income stream, a debt instrument, some kind of money that they can use to then construct that facility. And we're basically taking the same model and applying it to a sector that has a lot of similarities to that, but of course is at a much smaller scale, right? So we know that we need to do these things from a climate perspective. We know that we need to remove approximately 10 gigatons of carbon emissions by 2050. That is 10 billion tons. For most people, that's a very, very difficult number to grasp. But if you take and say, okay, between now and 2050, there's roughly, give or take, a little less than 30,000 days in terms of that, right? So we have 10,000 days between now and then, and we need to essentially create a 1 megaton facility every day between now and then, right? That's the scale of it. So 10 billion is 1 megaton. 1 megaton is one very large district heating or power plant in a medium-sized city. Like that's roughly a megaton. So Stockholm has just done this. They're a city of just below a million people. Their facility that provides energy and district heating to Stockholm has an emission of about 1 megaton. So that project has gotten off of the ground by an offtake from Microsoft and a couple of Nordic companies. And then basically against that money, the facility has been able to put that in place on that facility in the city. And this is essentially what we need to replicate 10,000 times between now and 2050. So the market potential in terms of what Cam was speaking about is huge. What we need to do is find a model that works, find the technologies that work. So the one in Stockholm is a bio-CCS type facility, so bioenergy with carbon capture and storage. Then we have a range of other technologies, but what unifies them is the capacity to take CO2 out of the atmosphere. And the model in which we can scale this is to have the corporates come in and say, okay, look, we have net zero targets. Just like we need to invest in renewable energy for that net zero target, that's the reduction pathway. Then for the net to become net, we need to take CO2 out of the atmosphere. And this is the other side of what they need to come in and provide the same capital that they've been providing for wind power. They need to now provide that for energy facilities to become net zero.
Yeah, brilliant. And, it's such good points around the commercialized technology already exists, and a lot of the heavy lifting is being done by wind, solar, batteries, all established technologies. But then you've got these breakthrough technologies as well that have massive scale potential, and potentially venture debt from a bank as well to go alongside and help scale that further. But then when you get to commercialized technology, that's where bank finance, other sorts of project finance can come in, and you're starting to really get a bigger bang for your buck. So, super interesting. And you all touched on the point around impact and returns, and we're going to just really dig into that. So, Duncan, I'm going to come to you with there's probably a tricky question here. Will your investors take a lower return for the impact that you're giving them?
No.
Ask a closed question, get a closed answer. Fair enough.
I think the answer is no. A lot of our investors, as I mentioned, are, well, particularly when we're looking at like something like the DC pension side, which is a majority of the money that I manage, their trustees have got fiduciary duty, and a lot of debate in that market at the moment. But kind of most trustees would say that their kind of fiduciary duty is to maximise kind of the risk and return of their investment. And I think they have a reasonably narrow view of what the risk is from that perspective. I'll go back to those saying that thankfully we're not in a position where we need to make that compromise, given kind of where we sit in the market today, particularly kind of the amount of capital that's required for large scale projects. We're seeing fantastic returns, and we think kind of fantastic returns in our sector are different to the returns that we're seeing in other parts of the infrastructure market. So thankfully we don't have to make that compromise, but if we did, the answer would be no.
So I'll have a much more differentiated answer to this. We actually have quite a few investors who would like to earn a lower return, but they have very specific points in mind for that. So on the one hand side, they would very much like to mobilize much more capital for climate investments. So some of these investors are actually willing to accept more risk, or let's say more perceived risk, because actually in emerging markets, often the default rates of companies are much lower than many of the developed markets investors perceive. So some of these investors are prepared to accept a potential lower risk, but they would like to mobilize 3, 4, 5 times more capital into climate investing. And how they do that is by actually being able to offer to institutional investors solutions that look just like what Duncan is offering, something that has an attractive market return that is, where you're not compromising anything, and promise similar risk return as for Duncan's solution. And that means that also insurance companies, pension funds, private banks are investing then in our solutions. And then, the other investors, they are taking some first loss for a lower return in a structure that is kind of tiered, where, they really want to mobilize more capital into emerging markets, into climate solutions. So there are investors who actually want to do that. And who are these investors is maybe also a good question. It's not just the public sector. It's not just the UK government. They're actually increasingly also wealthy families that are prepared to go all the way, particularly when it's like second generation of successful entrepreneurs who say, like, we really need to do something. And we want to have much more money into climate finance flowing. So we are willing to also take more risk.
Right. And Cam, how about your LPs?
Yeah, I think it's a slightly different environment for us, simply because our investors are targeting a return, but that is not a sort of a steady state 7% every year or 5% every year. What they're after is, of course, outsized returns from a proportion of their portfolio. This is an insanely risky area in which we're investing. So literally, this is probably one of the highest risk areas, real genuine startup companies. And the expectation is that a third of their portfolio will just fold and those companies will not return any money at all. And so they're after outsized returns from the sort of right-hand end of their portfolio to cover and make a really good return across their entire portfolio. What's a really good return? Well, we're targeting 3 times return over a sort of a 5 to 10 year period. This is not pension funds. This is not large infrastructure projects. This is very wonky, very illiquid, and very risky startup businesses. And so they're not saying, "Oh, if I just trade 2% here, I can get that extra climate impact," or if I just sort of invest a little bit more, I can get a project seeded and underway. Not at all. They're saying, let's invest across a portfolio of, let's say, 20 to 25 businesses to ensure that I give those 25 businesses a really good chance that 8 of them will actually succeed and scale hugely across their whole portfolio. So it's a bit of a different question.
And maybe just on that, I think we jumped a bit in at the deep end in terms of, pension money and very large scale infrastructure and those kind of things, right? When we look at a lot of these technologies in the sector that I'm in, for example, it is really the money that CAM has that's relevant to most of them, right? It's VC type investment so that they can get the technology from a lab stage or a pilot stage to a first of a kind, semi-commercial stage project. And they will require an equity investment, a venture capital type investment to get there. Then once they have proven that works, once they have shown, okay, we can actually build a solution which is scalable, well, then we go to the more like institutional type investment, right? So in the space that we work in, we try to say there are some technologies that we know right now are basically loss making. Like they are an extremely inefficient way currently to take carbon out of the atmosphere. Take things like direct air capture. It is vastly inefficient at the moment. It is like where wind power was in 1982. It doesn't make any sense from a commercial perspective, but the potential in doing it is quite vast. Like the theoretical potential for this is really that it's probably one of the technologies we need to use in 2050 to get to gigaton. So that means if we don't invest in it now, well, then we have a very bad, worse chance of getting to net zero in 2050. And this is where, for example, one of the companies we work with, both a Belgian startup that operates in Kenya and UAE and a Kenyan startup that operates in Kenya are building DAC machines. And they are doing it at a very, very high price per ton right now. But the investors in that have said, okay, look, if we can make this successful, well, then that company is going to be massive in 2050 because it is probably the technology in terms of getting to net zero that we do not have solved yet, so to speak, right? We know wind power works. We just need to do it more and more and more. And we know we can make money doing it. We haven't really solved the net zero part of the net zero, well, the negative part of the net zero equation. This is where money like CAMS and other types of, early stage green tech money can go into these companies and can help them get off of the ground. And then maybe a lot of them will fold, like a third or half or whatever. And then some of them will be outsized businesses relative to what was invested, right? And that's a fund return for those. And I think we need to think about these kinds of capital provide different, or they serve different purposes in terms of getting us to these different types of sustainability innovations.
Yeah, I mean, I think we hear from all of you, everyone needs a risk-adjusted return. We as a bank need a risk-adjusted return as well that covers our cost of capital. We all have different risk tolerances, different spheres, and what that exact return looks like differs depending on the risk you're taking. But
we're all doing a job for our investors. Our
exactly.
investors want different things.
Yeah, 100%. So we're all in that ecosystem. We're all working towards the same outcome of net zero transition. I think there's this spectrum of capital with different risk preferences that you can deploy. So then I think it really gets onto how do we all work together in deploying that. And Stephanie, maybe if I start with you, how are those partnerships working in the emerging markets and particularly blended finance?
Yeah, so I alluded to that in the previous answer. Basically, we define, okay, what's the kind of traditional return that our institutional investors would expect on this kind of investment. And let's say it is, corporate or infra, quasi-infra debt type of return that they're looking for. So how does it need to look like that it's palatable for institutional investors, so it looks like what they normally invest in? And then we kind of work it a bit backwards and say, like, okay, for that to work, what would be the risk taking that we need in terms of the concessional money to come in? And typically we structure these in a 2 or 3 tiered type of structure, very much like a CLO or so in terms of risk returns. Equity, the lowest part of the tranche takes the highest risk, and then in between you have a mezz piece, and you maybe have some notes on top, and basically for each of these different tranches you have different risk return types, and we work it backwards so that the institutional investors kind of recognize this as one of their traditional investments. And typically, the lowest part is taken by governments. As I said, the UK has worked with us on a global climate partnership in the past, but also the German government is very much involved in these kind of things. And again, at the end of the day, it doesn't really matter where you save the ton of CO2 emissions. You just need to save it on the planet globally, and that's what counts. And that's why governments are also actively investing in emerging markets for that. And then in between there are, as I said, also philanthropists, there are family offices, and then institutional investors who invest in the various different tranches.
And Duncan, how about on your portfolio, and where do you see lower cost capital coming in to complement what you're doing?
I think in terms of where we're seeing lower cost capital come in, it's very much at those end of the de-risk projects, and particularly in kind of geographies where people are particularly kind of comfortable, and for UK investors or European investors, that's often in kind of European projects. And so a lot of the things that we're investing into are, as I mentioned, kind of operational wind, solar assets. Moving up the kind of the spectrum in terms of looking at things like batteries and hydrogen, but interestingly, kind of both of those markets are only things that we've looked at over the last couple of years, because actually, kind of the ability to identify cash flow coming off those assets has really been only really kind of come out over the last 2 or 3 years or so.
And Cam, I guess you're probably mostly investing just alongside other equity investors as opposed to having higher ranking capital. Maybe you tell me otherwise. Yeah. But what's the dynamic you see on your deal?
So really early stage, yes, everybody will be on exactly the same terms. There'll be no preferences. It'll be just very, very simple paper. We will typically invest straight after a sort of a friends and family round. The company might have raised 40 or 50 grand from friends and family, and now we come along. And with some co-investors, yes, we're putting in sort of 500,000 in a 1 million round, something like that, really early stage. And then as these companies grow and they pick up larger institutional investors, yes, maybe some preferences will start sneaking in. And then depending on the style, I guess the business model for these companies, depending on whether they are hardware intensive or they have a big logistics facility, we might see debt financing for projects growing those businesses. And then ultimately there'll be bank or other financial institution investment as these companies get to be much more stable, much more predictable with their revenues, hitting a greater scale, physically able to take 200 million pounds, which they definitely can't on day one, and actually do something useful with it. And so, yeah, we see that blending over time. Where Green Angel Ventures fits in, as I said, is that really early stage. And then what we're trying to do is to grow, like we're all saying here, to grow our investors' money to a point where maybe an exit is right for us. So that might be part of a secondary round. There's maybe other institutional investors who want to get in on the cap table and will buy out some of our early stage investors. But actually at that point, it's such an interesting dynamic because our early stage investors may want to stay with that company for an extra stage or two's worth of growth. And so what we typically see where there's an opportunity for our early stage investors to exit from those companies is so psychologically interesting. They have in the past tended to liquidate about the same amount of capital that they invested in the first place. And essentially they've totally de-risked that investment by getting back their capital, and then everything else is there for the upside. So they can take that early stage capital, get it back and put it into something else, because that's really what they want to do, is they want to fund that innovation. They want to fund that early stage growth, and they can, with a good secondary exit, they can actually do both of those things.
Brilliant. And Simon, with the project developers you work with, how have you seen them go on that journey from early stage through to project financing and really scaling up?
I mean, it depends a bit on the technology, right? Like, so we group these carbon removal and net negative emission technologies but really there are like different technologies in there, right? And you can invest in some things like reforestation. It's basically something we invest in already, and we do it for timber production and whatnot, right? But if we sort of stick to the more like technology-based ones, I would say that, for example, things like producing biochar or embedding CO2 in construction materials and these kind of things, that is a bit more proven. We are seeing that they're moving out of, they have raised a round to get the company off the ground, and then they might use some kind of SPV to get a project facility off of the ground. An example I just shared with you when we were discussing this in the beginning was a project that does biochar in Denmark, where we know that there's a corporate interest in the facility or in the company. And then against that interest, against that contract from the company, they are then able to raise debt money from an investor to get the facility off of the ground. And of course, that investor is expecting some kind of return. I think I would still say that this is more risky capital than when we look at, for example, wind power. So they have to have a risk-adjusted return, of course, but it is, in that sense, it is a different instrument still than many of these things. And then I think when we get to the sort of the company itself, we also see that there was a big sort of flurry of interest in like 2020, 2021 to two, maybe. Then a few things happened in the broader market around interest in green tech. And I think now we're seeing a lot of the ones that are still there are the ones that sort of will survive a little bit. They have made it past sort of the first very early pre-seed round, are now raising Series A capital, are actually raising money to expand their company. So they're raising money not only to just say like, okay, we have this technology, we need to get it off of the ground. But no, we have this technology. Now we need to prove that we can do it at scale. So some of these technologies are moving into the second stage where maybe some of those angel investors of CAMs will be bought out. And then larger, either private equity or other kinds of investors, late stage investors will come in and take the company from 25 people in a small office in Berlin or London or Copenhagen or whatever, and then how do we get this to become a 2,000 employee company with a multi-million return? So we are seeing that happening, but we are still, as I said, very early days here, and I think we need to see the corporate interest in the actual facilities to have that happen. Right? No one is going to invest in these Series A companies if they don't have the ability to sell. And to sell, they need the corporate interest, right? So it's all like a big chicken and an egg kind of problem, right? So someone has to take the risk at different stages. And luckily we are seeing it. But of course, with, geopolitical risk and other things, it's some of the capital has become more expensive. We see that the requirements put both on us as a startup, my own company, but also on some of the companies we work with, they have been adjusted a bit. You have to be a bit more solid than you had to be in 2021, for example, where the money was cheaper.
I think I would like to come back to that missing middle part that we are financing, because that's a very interesting segue here. So once the companies get past that stage where technology is proven, it's all about how they actually make the business scale. And that's quite often actually what happens in emerging markets. We don't want to rely on sovereigns and so on in terms of the risk that we take, but rather we would like to finance a business model that is attractive to someone who's taking up that risk, like multinationals, big corporations. So just imagine, solar panels is a very classical example. There are many big corporates in emerging markets who like to build decentralized renewables energy on their plants, and for several reasons. Mainly because it's cheaper, and second, because the electricity is also more stable than the grid. So these project developers are sometimes quite young companies, but they have a proven business model how to do it. They build these renewable solar panels on the plants, decentralized. They do this and they do that for the next plant. It's usually quite small scale projects, so not interesting to the big guys like yours. But for us, when we bundle that kind of risk and look at it, what does it actually mean in terms of risk? It's a commercially viable business model, and there are big off takers there, like a Pepsi Cola, like a Tata, and the type of risk in 20-year offtake agreements for this electricity from the solar panels is just a very attractive one. It's very low default rates, so that's a really scalable business model that is being built across emerging markets and is very much 1-to-1, CO2 emission reduction.
Yeah, and I think sticking with that point around corporate offtake, so we're in the carbon removal space, we're piloting an offtake finance product which effectively takes an offtake and advances funds to a project developer to go and develop that project and deliver carbon credits. One of the things, and not just in carbon removals, but other corporate agreements that we see, often you've got an investment grade buyer, which is a huge tick. But how do we get really bankable contracts where ultimately, to your point, Simon, around who's taking the risk? Certainly as a bank, what we'd be looking for is really that corporate bears the risk, maybe with insurance backing it up. Are you seeing that happen? Are corporates up for that?
We're getting there, but of course there are a lot of bumps on the road, and I mean I think for those that might know a little bit about this space, they would have seen that Microsoft has really sort of paved the way. We were also part in my company in working with an Indian project to Stephanie's point on where are those where those projects that are not necessarily in the established markets, but also in emerging markets, and there Google was sort of the one sort of driving and made probably I mean, I didn't see the contract between Google sort of riding off of the back of Google's investment, right? But that investment allowed some of our buyers to sort of support those projects, right? So someone has to take the risk, and I think in this space, big tech, in carbon removal, big tech has shown a willingness to do that. But right now, for example, we're also seeing the emergence of different types of standards, different types of standard offtake contracts that are being used and being tested against this. And of course, there will be a degree of risk put on everyone in this. There will be, I mean, the corporate isn't going to take all of the risk. They are willing to take a substantial amount of the risk, but the insurance is an important play. That is slowly emerging in this space. The banks, the financiers, they have to take an element of risk in that. The company itself has to take a risk in that, right? So everyone is sort of taking a little bit of risk, and how that is being adjusted across is basically a constant negotiation, right? Like, how willing are the different parties to get this off of the ground? And some things like in the technologies as well. Like if we are looking at DAC, well then if you buy that, you know that you are buying a high risk technology in the sense of we don't know if it is able to scale. And if you buy some of the other technologies, when Microsoft made a contract with Ørsted, we are talking about like one of the largest utilities in Scandinavia and one of the largest companies in the world. I mean, those companies are both able to assess that and take that risk against each other. That's a very different deal than if you have a startup in Kenya being vetted by someone like us and maybe with Google as a sideline. There they know that they are taking a risk against the company itself, and that very likely that amount of money might be lost. And of course, the investment between Microsoft and Ørsted is an order of magnitude larger, probably 2 even or 3, than the investment into that company in Kenya, right? And that is because they serve different purposes. So we are luckily seeing that emerging. And I think that more and more companies are sort of walking in the footsteps of the big tech companies here and seeing them sort of take the very, very early risk. And then they are more able to sort of follow right on the back of that.
Yeah, and Stephanie, how much are you seeing corporates, multinationals going into emerging markets, taking risk on innovation, seeking to scale them?
Again, it's not about taking innovation risk, but it's really much more taking commercial risk, that you can calculate, and then looking for the right solutions. We've recently done that with a very interesting transaction in Malaysia, where we had one of the large, multinationals taking off some electricity produced by a relatively new technology out of palm oil waste, and we basically from that create the biogas together with a relatively new developer, but having a proven track record of building these kind of businesses. We help them structure it so that it's really low risk with regard to and the multinational basically gave us a long-term contract to actually build that facility. And we're going to do more in other countries with exactly the same setup. Relatively new company, with the multinational taking the offtake agreements. So yes, they are willing there, and it does play out that they also made big promises towards a net zero supply chain. So I do think that some of these also plays up very positively to actually following through and thinking more creatively how to set it up.
I think I'd also say how important it is from a technology perspective that if a big corporate comes into a space and gives a really good indication of support for that space, there's 8 to 12 other competitors out there who are not the ones with the contract, but that from an investor's perspective, that just gives a lot of solidity and a lot of show of support for that new technology for that space. So they're essentially helping crowd in other investment through their sort of path leading, if you like.
I mean, there's a perfect example of that in CDR where Microsoft stepped in, and then as a result of that, Google and Alphabet, Facebook or Meta, McKinsey, and I think also now recently Anthropic joined that coalition called Frontier. So Microsoft's action led their immediate competitors to do exactly the same. And we have seen that, also the finance space, the banking space was the next. JP Morgan was first to step into carbon removal, and now other large investment banks are stepping in there as well, right? And I think that's such a key signal because no one really likes to be the first, but also no one really likes to be last, right? So once someone has done it, all of the other ones are following right after.
Yeah. And Cam, do you do much with corporate venture capital? Do you see them come in at later rounds on your portcos?
Yeah, certainly. And interestingly, the sort of corporate venture capital approach is not just for specific companies that want to raise finance, but it can be, a really good injection to a fund. For example, we have some CVCs and family offices that invest into some of our broader array of a portfolio based approach rather than into individual companies. And though that money often comes, like we've been discussing here, with specific intention, if you like. So, looking for the new technology or the new competition in that market to get ahead of and get investing into, so that they can essentially de-risk or expand into a different market than they currently do today, just through taking that early stage investment and building a relationship with those firms as well.
Oh, great. And Duncan, you'll probably have some older assets coming off subsidy schemes. What's the corporate PPA market like for those? And how are you kind of delivering that return to, having a high quality buy?
Yeah, so generally I think the corporate PPA market's really, really strong at the moment, actually. I mean, we're seeing in many places of the world increasing kind of the demand for electricity increasing quite substantially, kind of with what we're seeing with kind of obviously with data centers, but also kind of just general electrification. So actually kind of in many places of the world, we can actually get kind of nice PPAs. And in some places, we can actually get better PPAs for green power than we can for brown power. And what we're seeing kind of for brown power in the marketplace. So very confident about kind of how that's going to kind of go over time. And obviously as a corporate, kind of being they've also seen kind of what's been happening with energy prices recently. And so their ability to fix that in over a period of time is obviously very valuable to them. Particularly when you get kind of to a portfolio of scale and you can provide diversification across wind, solar, batteries, other forms of electricity, also kind of helps in terms of getting that kind of better power price over long periods of time.
Yeah. And the other thing we're seeing is a lot more interest from corporates on matched renewable energy. So, not taking certificates, but really knowing where it comes from and making sure you can source it. And that feeds into some of those PPAs for the new suppliers that are coming through.
Exactly right. Yeah.
Yeah. But look, I think in all of that, I think we can all conclude corporates are really key to this. We engage with our corporate client base on their transition plans and how they are thinking about innovation to decarbonize their own businesses. But, often they're the anchor buyer. They'll be the offtake that we can finance against. And that's where you really get a nice virtuous circle.
I mean, from our perspective, it's not only just kind of repowering kind of corporate PPAs. We can now build a solar plant with a long-term PPA, kind of 10-year PPA that kind of underpins the economics. And so it is actually kind of economic today to build solar, wind in places where it's sunny or windy. And you can do that kind of, and they support projects on their own.
Great. Well, we've got about 15 minutes left, so we'll move to Q&A with the audience.
Hello, thank you very much for this discussion. Very interesting. I wanted to know, I think there's a lot of focus on carbon, but looking at climate sustainability innovation, is there anything else you can tell us about in terms of technologies and startups that you're looking up and supporting? And also, again, in terms of insurance coming to help and de-risk, for me, I've come across a couple of specialized insurance now that are looking exactly in this field. So, wondering if you how much interaction you have with insurance at the moment.
Maybe should I take the startup question and one of you guys can tackle insurance? Thanks very much for the question. So maybe the way to answer your question is what we tell prospective investors into our climate change fund, and that is we'll invest 80% of their money into solutions that we think have a direct carbon impact, and then 20% in what we call sort of supporting or ancillary technologies and approaches. And those might be nature-based solutions or technologies that support measurement, but not necessarily direct impact. a great example of this would be a portfolio company of ours called Nature Metrics. Nature Metrics has an environmental DNA measurement system, eDNA it's called, which allows you to essentially put a number on biodiversity. So measure the biodiversity of a particular area using soil samples or water samples from that environment. And that for us is super important. You cannot improve biodiversity unless you can measure it. And so that company doesn't have a direct carbon impact, but is ever so important to those surrounding areas to improve our biodiversity, which, as we know, is increases in biodiversity are such an important carbon sink. So hopefully that answers your question.
I mean, we've been doing a lot in these markets as well. I mean, yes, I mentioned climate mitigation has been something we've been focusing on for the last 15 years. That includes not just renewables, but also mobility, industrial decarbonization. And I mentioned that we also finance quite a lot in actually climate adaptation. And that, of course, goes into nature and also other businesses, make them more resilient against climate change. That, of course, is a bit harder to measure what it actually means. But with every company, we then select specific KPIs for how we measure this. And we're actually working right now exactly also with insurance companies that are, on the one hand side, our investors in our climate funds, but on the other hand, of course, are already experts how to account for climate risk, event risk, weather risk. And we are running some pilots with regards to the risk that we have on our projects on really building more resilience into it.
Over here.
Hi. My question is mostly for Simon in relation to this interesting area that you're working. What sort of size is that market really? Is the demand more than supply? Are there more people out there willing to commit to a long-term offset, like you were talking in relation to other industries, or is the request for that greater than the supply?
Thanks for the question and really good area to touch upon. I mean, first of all, it's tiny, right? And it's because it's starting from basically zero. One of my favorite things to say is that the market for carbon removal is still smaller than the market for toothbrushes. I know we all need to brush our teeth, but still it's a very sort of, small market compared to a lot of other things. The potential, however, back to Cam's point earlier, is massive. So right now, we have seen in the total market, roughly there's been contracting done by different actors for roughly 50 million tons of negative emissions projects. So that is a couple of $1 billion invested last year. So it's not nothing, but it's definitely, not a very large market. But it has grown approximately 40% year on year in the past couple of years. So it is getting there. But what we need to see for that to really grow, of course, is also that this becomes an asset class. It relates a little bit to the question before, right? We can't insure things, we can't bank things if we don't know what that asset class is. So right now, in terms of supply and demand, certain technologies are in higher demand than what they can supply. And that again relates to sort of the risk profile. If you have a European biochar or bio-CCS project that is able to also deliver energy, for example, well, then you have an investment project that is in high demand. We know it works. It's in a region that needs energy. It can help also get us off of, say, fossil fuels or Russian gas or whatever it might be. That's very sought after. If you have a very early stage, say, direct air capture technology, then the supply is currently larger than the demand not in terms of the amount of carbon delivered, sort of stored underground, but the amount of companies out there seeking someone's offtake. There's less companies willing to buy that than there are startups out there. That's also how it should be, because very early in these markets, we do need, this is very cynical, right? But we do need a lot of them to fail. Like that's how innovation works, right? We need to have 1,000 bets on 1,000 horses, and then 800 of them won't make it. But those that actually make it will deliver a sizable impact. So it's hard to say a little bit in terms of like supply and demand. Depends very much on what you are in. And as we see this move forward, we see that there will likely be some technologies that will be the winning. We don't think it's one. We think right now we work with approximately 12 what we call pathways. So 12 ways you can get carbon from the atmosphere into the ground. Some of them, like a bio-CCS facility in Europe, as I said, we know it works. Now it's a matter of getting more of them. Others, DAC, we got it out of the lab, but that's approximately as far as we've gotten so far. We think it might work. theoretically it works. Now we need to prove that we can make it work. And then there are probably others where actually, it was a good idea, but we couldn't make it work. And as a society, we'll sort of deprioritize that technology going forward. And that's fine. So I hope that answers your question.
Thank you very much for all your comments. My question is connected to forest conservation and nature-based solutions. We have seen a lot of movement of capital going into removals, and we are paying attention to what is happening on the ground. The number, when you compare number of deforested hectares compared to what is restored, there is a big gap in there. And touching on the point of carbon and other solutions as well, we know that forest conservation is not only about avoidance, it's not only about capturing carbon, but also about ecosystem services that such intact forests like tropical forests provide. Do you see any movement in capital at some point going into forest conservation? To anybody who would like to comment on that?
I'll have a go. I as I mentioned, I sit in Schroders Greencoat. We do infrastructure, but we sit within what's called Schroders Capital, which is a broader group of private assets investors. And we run some multi-asset products for some of our clients. Some of my colleagues run those multi-asset products, and actually, kind of nature-based solutions is in that remit. I think kind of their reality of kind of what they've been looking at when they've been trying to deploy capital in that space is that, going back to that question about kind of risk and return, the returns you're getting for the risks that are perceived in that market have just been, it's been very difficult to justify making investments into that area versus some of the areas that we've talked about today, both from a risk and return perspective. I think the other kind of challenge that you've got is kind of the size of the markets. And so when we're looking to deploy institutional capital into those markets, they've generally been reasonably small. And so actually kind of the bang for buck in terms of when you're kind of the amount of capital you can deploy versus in other areas just hasn't been as attractive. And so from that perspective, we haven't been able to deploy as much into that area as what we thought we might have been when we started running those products. I mean, I think we continue to look, and there is hope that kind of over time that will become a bigger area, but I think it really needs to be led by that kind of that risk and return.
Actually, just to illustrate that point, HSBC announced earlier in this year philanthropic funding into nature-based removals and nature-based solutions. So you can see it's at that level where it's not commercial risk that we're taking; it's a philanthropic pot. But the idea is, as that capital comes in, those solutions scale, the market matures, then you can start deploying commercial capital, which is where you can really, really grow it.
And this is not all about commercial capital either. You know, governments have a role to play here, particularly with legislation and protection of nature areas that need to not be chopped down. Capitalism here is not going to save the world by itself. That for everything that we've talked about here, we're in just one part of the sector, one part of the space. There's philanthropy, there's legislation, there's other actions as well, and they all need to happen together for us to fight the climate crisis effectively.
Right, I think we've got time for one last question.
Thank you. Very interesting panel. My question is more for Duncan specifically. When you say that, fortunately, you don't have to compromise on returns, is it because your investors understand the importance of sustainable long-term returns, or risk is accurately reflected, climate risk is accurately reflected in those returns?
Yeah, it's a good question. I mean, I think thanks for the question. I think when our investors do recognize the value of sustainable long-term returns, but sustainable with the small s, kind of the ability to generate kind of longer-term cash flows that come from these investments is very attractive to them. So in terms from that perspective, kind of yes, they focus on the sustainability, kind of the returns that are delivered. I think in terms of kind of the understanding of the risks, the area that we're in kind of is further down the risk. And we've talked about kind of we're focusing on a return of 10 to 12%. And within a 10 to 12% type of return, you need to parameterize what risks you are willing to take. And I think within the ability to be able to do that in our area and for people to understand the risks that you are taking is reasonably well understood by investors today. I think it's taken a while to get here. I've been investing in this space for probably the best part of 15 years, and it's really only been the last 6 to 7 that people have actually really started to understand the economic value associated with these assets. So I think it's a bit of both kind of sustainability, but as well as kind of understanding the risks.
Great. Well, thank you for the questions. We will close with one final question for each of our panelists as a quick fire. Going into a red heat alert, all doom and gloom, we're all feeling miserable. Give us one thing that you're most encouraged about going into the second half of this year.
The thing I really like about my job is that we assess 1,000 funding applications every year from 1,000 CEOs of 1,000 companies that want to get up every morning and change the world. And I'm absolutely positive that we will do that.
What I'm most excited about is I read the geeky press like many of you, and it's gone from being a lot of people complaining about the cost of these things to really focusing on kind of these are, from an economic perspective, very, very attractive assets to have, both in terms of kind of investors, but also in terms of the value they bring to society.
I actually think that regardless of what the press writes and the media noise that is going on for the last year or two, we've actually seen very consistent increase of demand of private sector capital wanting to invest in climate solutions. And that's actually making me quite hopeful. That also brings it to, scalable solution that are attractive to invest in. So we do see much more of this, and we have many more dialogues for large tickets from institutional investors for these kind of topics.
What a fantastic way to end the panel. I'm really hopeful with this because we know we have the technologies to take carbon out of the atmosphere. We know that there are actually companies out there doing it. We know that there are investors and companies investing into this. And now we just, quote unquote, right now we just need to scale. And that makes me really hopeful. We actually have the solutions available. It is in our hands to change this. And that's really exciting.
Brilliant. Thank you. Ended on a high. Enjoy the rest of your day. And there'll be another session up here next.